And typically, geopolitical events have short-term spikes. We saw this very clearly with the Russian invasion of Ukraine, where gold was moving up in the 6 weeks ahead of the troops moving over the border on anticipation of that happening. And within 6 weeks, it was just back to where it was. Obviously, if the market believes that a situation could continue to worsen, and there is that concern about the Iran situation, gold will tend to hold up. But you only have to look at the last few days. Gold has not built on that initial surge. So it's the economic factors that are most important in my view. And yes, they are turning significantly.
As tensions escalate between Iran and Israel, with the United States potentially drawn into the conflict, investors are once again turning their attention to gold. The precious metal has experienced a notable rebound as demand surges for safe haven assets amid the growing Middle Eastern crisis. However, global resource investing expert Adrian cautions against viewing such geopolitical events as reliable long-term drivers of gold prices. Adrian observes that while geopolitical tensions like Iran or Ukraine can cause short-term spikes in gold, they rarely lead to lasting gains. He explains that it's not war itself, but its economic aftermath, such as rising debt, government spending, and monetary expansion, that drives long-term demand for gold and silver as inflation hedges. This perspective challenges the conventional wisdom that sees gold primarily as a crisis-driven investment. The distinction between temporary crisis responses and sustained economic drivers proves crucial for investors trying to understand gold's role in their portfolios. Rather than serving merely as a crisis hedge for headlines, gold functions more effectively as protection against the broader economic consequences of sustained instability, whether that instability stems from geopolitical, fiscal, or monetary sources. When conflicts trigger massive government spending programs and central bank money printing, the resulting inflationary pressures create genuine, lasting demand for precious metals. What makes gold's recent performance particularly intriguing is its strength despite limited participation from traditional Western investors. Notes that this apparent contradiction isn't surprising when one considers that non-Western buyers have been driving much of the recent appreciation. Central banks and investors in emerging markets have been accumulating gold based on fundamentals rather than the crisis-driven sentiment that typically motivates Western investment flows. This shift in demand patterns represents a fundamental change in the gold market and carries significant implications for future price stability. Western investors have historically been major contributors to gold's volatility through their often emotional trading behavior, buying during crises and selling when headlines fade. The emergence of more diverse, long-term oriented buyers from non-Western markets could provide more stable support for gold prices going forward. Before we get started, don't forget to like, share, and subscribe. 97.4% of viewers haven't subscribed. Be part of the 2.6% who have by hitting that button and turning on the bell icon.
Say that the traditional factors that have made investors, particularly Western investors, buy gold as an investment, we're not talking insurance or security here, but the traditional factors, which are mostly economic factors, are turning in gold's favor. So if you look at the last couple of years, everybody's asking why gold is running, but Western investors, North American investors aren't buying. And it wasn't totally illogical because the people that were the forces that were driving gold over the last 3 years and the reasons that those people were buying gold had nothing to do with macroeconomic factors in the West. So the narrative was a strong economy, high interest rates, low and declining inflation, reasonably strong dollar. That's precisely the wrong environment to be buying gold. But those factors are turning, and we don't need to go too much into it, but it's fairly obvious to me that the economy is showing signs of slowing. The dollar, as you mentioned, is showing signs of weakness. Geopolitical factors have always generally have been very short-lived. That's not what drives gold on a longer term basis. You only have to look. I mean, I've done a study on this going back to the Iran hostage situation. Funny, it's Iran again, but the Iran hostage situation in 1980. And typically, geopolitical events have short-term spikes. We saw this very clearly with the Russian invasion of Ukraine, where gold was moving up in the 6 weeks ahead of the troops moving over the border on anticipation of that happening. And within 6 weeks, it was just back to where it was. Obviously, if the market believes that a situation could continue to worsen, and there is that concern about the Iran situation, gold will tend to hold up. But you only have to look at the last few days. Gold has not built on that initial surge. So it's the economic factors that are most important in my view. And yes, they are turning significantly. As we know, in the last couple of years, the gold stocks, although they moved up, did not exhibit the traditional leverage that we associate with the gold stocks over bullion itself, nor the silver stocks over silver. But again, there were logical reasons for that. The people driving the price of gold, the central banks of the world, Chinese, non-official Chinese investors who were buying gold, and frankly, just wealthy individuals and families concerned about the fiscal situation around the world, as well as other things, the massive debt. Those people wanted physical gold. The central bank of Uzbekistan doesn't go and buy Newmont Mining. And so that's why the miners kind of didn't exhibit that leverage. We're seeing it this year, as you mentioned. Both of the GDX and the GDXJ are more or less double the performance of bullion this year, and the silver stocks are outperforming silver. And that, again, in my view, is a reflection of the fact that North American investors, whether they're retail investors, family offices, hedge funds, whatever, North American investors are finally turning towards gold, the gold space, which means they're buying silver, they're buying gold stocks. And I think it's just beginning. You look at the inflows into the GDX this year, it's still massive outflows, over $3 billion or nearly $3 billion right now of outflows this year. It's only been in the last month, but we've started to see meaningful inflows into the GDX, and the GDXJ has only seen a few days of net inflows this year. This might just, I'll close on this, but this might astonish you. I think the bull market in gold stocks has only just begun. To use a cricket analogy, maybe the third batsman has just come in. That's like the second innings in baseball, I think.
According to Day, the silver supply landscape has completely reversed from its historical pattern. 25 years ago, primary silver mines accounted for approximately 78 to 80% of global silver production. These were mining operations specifically designed and operated to extract silver as their primary product, allowing for more direct control over supply levels based on market conditions. Today, the situation is flipped entirely. Roughly 75% of silver now comes as a byproduct of mining other metals, including zinc, lead, copper, and gold. Only 20 to 30% of the world's silver originates from dedicated primary silver mines, with the remaining 70 to 80% produced incidentally during the extraction of base and precious metals. Day notes that while global silver mine production has generally increased over the past 25 years, this growth has failed to keep pace with surging industrial demand. The result is a progressively tightening supply-demand balance that puts upward pressure on silver prices over time. The timing of this supply constraint coincides with silver's expanding industrial applications. The metal's unique properties make it essential for electronics, solar energy systems, medical devices, and other technologies experiencing rapid growth. As these sectors continue expanding, they compete with investment demand for an increasingly constrained supply. Let's get back to the interview.
I would agree with what Jeff said on the silver stocks. I think it's a time not to chase them, but to look for dips and so on. You mentioned, Jesse, that there are far fewer silver. You said you used the word pure silver mining companies, miners or exploration, than there are gold, obviously. And in the gold space, as an investor, there's 3,000 gold stocks around the world. I can pick and choose management, size, jurisdiction, etc. You don't have that luxury in the silver market. It's difficult to pick a silver stock and be very picky about jurisdiction because you just don't find big silver deposits in many countries around the world. One thing I want to focus on, if I may, is, everybody knows the silver demand is different from gold demand, meaning there's a lot more industrial demand. I think it's been increasingly widely recognized that the supply side is also different. The silver supply side is different from gold, but it's also different from what it was a quarter of a century ago. Traditionally, and even up until, as I say, 25 years ago, something like 78 to 80% of silver came from primary silver mines. You also had some silver stockpiles, by the way. Today, you have virtually no silver stockpiles, although at a certain price, it'll always come out of the woodwork. But you don't have large silver stockpiles. But perhaps more importantly, most silver production now is byproduct, something like 75%. So it's completely flipped. 75% of silver production is byproduct. Now, some of that is byproduct of gold, but a lot of it is byproduct of zinc or lead. And so the lead miner in Bolivia or the zinc miner in Peru does not increase his zinc production or open a new zinc mine just because the price of silver's changed. So silver production does not change very much. It's not responsive to changes in the price, up or down. And that's one of the reasons why silver prices, Jeff used the word spiky, move so much more. They're much more volatile than gold because the production does not respond to changes in price. So having said all that, and also focusing on the fact that there are pretty few silver names out there, what you find is that companies like, let's just say Pan American Silver, which is the second largest silver producer, I think, or one of the largest silver producers around, it produces last year it had 18% of its production was from silver. So gold was over 50% and the rest was base metals. Even with the MAG acquisition, it moves to 22%. And yet because it's Pan American Silver, it will move when the silver price moves because investors are looking for silver stocks. Even Fortuna, which has changed its name from Fortuna Silver to Fortuna Mining, because for that very reason, they produce much more gold now than they do silver. But even Fortuna responds when the price of silver moves. So I agree with what you said. I agree with what Jeff said. When silver really moves, investors are going to start looking for a relatively small number of names, and they're going to have outsized returns.
Gold and silver are gaining renewed attention as economic fundamentals shift in their favor. Temporary geopolitical spikes aside, long-term gains are driven by inflation, rising debt, and currency concerns. With silver facing supply constraints and gold supported by weakening economic signals, both metals are emerging as strong long-term investment options. Will gold and silver hold their strength as economic pressures build? Let us know your thoughts in the comments below. If you found this video helpful, don't forget to like, share, and subscribe. Thanks for watching.